everybody. Brett Rice with Core Vision Financial Group. Today we're going to be recording another episode in our video series on financial topics. And we'd like to ask that you go to our YouTube page and subscribe, so that way when we post a new video, you're notified of that, and that way you can watch these as we put them out. Today we'll be speaking with Jason Pike, and we'll be talking about emotional investing and the roller coaster ride that is the stock market. You know, how do we stay on track and, you know, with our long-term goals in mind when the market's down and the market's up, and how do we reset our expectations when a market's going down after it's been going up for a long time? So I hope you enjoy this video, and again, go to our YouTube page, subscribe, appreciate it, thank you. So joining us today is Jason Pike, one of the partners at Core Vision Financial Group. Jason's been on the podcast a bunch of times in the past, so most of you are probably familiar, but for those of you that aren't, Jason's going to give a quick bio on himself.
Appreciate the intro, Brett. Like Brett mentioned, my name is Jason Pike. Been here at Core Vision since it started. Actually, this year hit 18 years of experience in the industry, so I have gotten through my high school years as the same amount of time as being in school as working, but you know, I've got 4 more years, and now I'm there, right? Now it's officially the majority of my life.
Like midlife.
Yeah, officially the majority of my life. So, you know, from that point, you know, we are constantly looking at ways to provide content, and Brett here does a great job for us. You know, he spends countless hours editing this content, putting these things together. So, you know, we do appreciate him doing that.
So today what we're going to talk about is emotions and how they play in investing. You know, when the market goes down or when the market goes up, people want to react one way or another, whether it's through greed or fear. People let their emotions take over that, right? So then you've got to, as an investor, you've got to be aware of your own emotions, but also as a financial advisor, we have to recognize those emotions and help people understand the good points and the bad points of allowing those emotions to impact your investing.
You're right on, and I say it a lot, but I think that, you know, oftentimes advisors, you know, there are a lot of things that happen behind the scenes, but I think 50% of our time can kind of be summed up as managing emotions. And, you know, constantly we're looking internally at our own emotions, plus we're hearing from clients, especially in times of volatility. You know, we've got to be cognizant of trying to keep emotions out of our workplace when it comes to the market. To give you an example, back in March of 2020 when COVID hit, you know, I would be probably considered a pretty emotional person, you know, just in theory, you know, just across the board. So personally, you know, we get a lot of these phone calls from clients, and I get it 100%. You know, from the youngest ages, we're taught to buy low and sell high by like our grandparents, right, or our parents, and it can be difficult when it's your money that you're actually watching go down. You know, where's the stopping point? You know, is it going to stop? Is it going to go down 30%, 50%? What if it goes down 70%? How does that impact us? So, you know, in times like that, what ends up happening is that can really snowball. And, you know, you end up with March of 2020 happening, which in a matter of 3 weeks, we saw a major correction into a bear market. In the U.S. markets especially, but I would say probably all markets worldwide, international markets as well. And it was one of those things where I caught myself, I had to really, you know, I was having these conversations with clients every day, and it's the same conversation over and over, just with a different person. The difference is I'm having every single one of them, right? And so when I'm having these conversations, it's hard for me not to, you know, as an advisor to stay as a third party and not to fall into thinking the same things that our clients are thinking, because it's very easy to do, especially as an emotional individual. During a lot of that time, especially that downtime, and even now, you know, during what we've kind of experienced this year to date since the early parts of January, you know, I rely on other people to take a look at my accounts. You know, I try to practice that, because the last thing I need is for my own personal situation to impact what I can do here at work for our clients and for all of our coworkers, and
Sure.
trying to keep that level ahead and trying to really look at history and try to keep that in mind, that, you know what, yeah, we've been through this before. Guess what? We're gonna go through something like it again. It just, you know, it could be something completely different that sets it off. And in times like that, it's especially when we get a big time lag on a long-term bear market. Think about it this way: when COVID hit, we'd seen basically the best bull market almost in the history of the market, right? 96, 98 years, you know. And so with that being the case, you know, we got used to it being too good. We got used to every year.
Stocks only go up.
Stocks only go up, right? They did.
Yeah, so one of the things I think you touched on that a lot of, you know, clients that I talk to is that time frame basically from 2009 through 2020. You know, 15 and 18 had some ups and downs, but the rest of the time it was up, right? I mean, that market run was a great run. And so then when you have some downtime or some downturn, now people are immediately like, what, I've been making 10% a year. Now I'm going to have a negative this year. What do we need to change? And you start going through that. So walk us through a little bit of that conversation and how, when you're talking to people about, hey, you know, as far as what's the long-term goal, how are we getting there?
But as far as conversations go, a lot of what we as a firm try to do is manage reasonable expectations. You know, that is, I think, first and foremost, probably the number one thing that you can do at the advisor level is manage client expectations. And before the market goes down, before we have a bear market, before we ever end up in a recession, it's talking about, hey, guess what? It's been a long time of really good. Like when you look at how you're diversified, you know, somebody in a 100% stock model, you know, let's say the S&P index, you know, if their average, the average of the S&P since it started, let's say it's 7.5%, give or take a few, depending on the day. Long-term average is 7.5%, but we're talking to people who over the last 10 years are averaging almost double that.
Sure.
Right?
Yeah.
And so not only is that happening where over a long period of time they're averaging these bigger numbers, but it's more of, at some point, it's going to average itself out. Somehow, some way. There's two ways that happens. And this is more of the conversations that we have with clients prior to even COVID. You know, prior to COVID hitting, you know, we were having these conversations like, we are due for something. Something is going to happen. Here's the problem. You never know what, and you never know when. And people that say they do get lucky. And they'll never talk about the times that it didn't work.
Yep.
Right? So with that being said, having those conversations, keeping those expectations reasonable. I mentioned the two ways that average returns can come down. There are only two components that go into average annual rate of return: total return and time. One of those two things is going to have to give in order to bring those averages back down to long-term averages. So if I'm sitting and having this conversation, but overall really setting reasonable expectations, talking about it before it happens, and letting people know, hey, this is the history of what you can expect. Either we got to get some more time with smaller returns and stretch that out so our average annual will come down, or we've got to get a correction to bring it back down. I always talk about it as taking one step back to take two forward. If the market didn't do that, it wouldn't be the market. It would be a bank. And we all know historical returns of interest rates versus the market. So
One of the things I like to talk to clients about in the education process is how a market works, right? When you have a run up in prices like we saw during COVID, I mean, as an advisor and, you know, an investment person that spent time looking at that, you know, there's no way they can continue to hold those ratios.
Right.
It doesn't make sense. As far as from a business model and from an investment, you're like, no, those are way too high.
You bet.
And then you go back and you look at the .com, housing, you go back and you look at some of those, we'll call them bubbles in the past, and you see similar type numbers. You know, the dot-com bubble when it ran up, right? They were running up ratios, percentages so high, you're like, everybody's making a ton of money. But at the same point, you have to think there's no way long-term those things can continue to do that. So the market, it's what the market does. People say, oh, this is too high, we got to get out of this. And it starts to come down. And then there's usually some economic event or some type of event that triggers that. And then brings that market back down, like you're talking about, bringing those average returns back down.
Sure.
So you've been through a couple of those cycles. You know, we talk to a lot of wholesalers, guys that come in here, and they start talking about, hey, this is what happens when the market goes up and down. Talk about portfolio design. You know, where are we at on portfolio design? Are you a 60-40, you an 80-20, you a 40-60? So when we start talking about that, you know, when people get those type of returns, setting the expectation of a 6.5%, a 7.5%, or whatever that number is, that's what we're looking for. And when you get an 11 or a 12, you got to say, hey, that's great. That's amazing.
Probably going to be a trade-off.
There's going to be a trade-off somewhere, 100%.
And if you start stacking 11% or 12% or 15% year over year, that compounding goes nuts.
Yeah.
And so your average annual returns of what you're getting versus what you should be getting, it just that gap just grows. So then it's going to take something a little bit more in order to bring it back down, or a longer period of time with, you know, flatline returns.
And it's done this historically. I mean, right? I think the number's like 17 bear markets since like the 1920s. So every 6 years, every something like that, there's going to be what we'll call, it's like a rebalance in your portfolio, right? It's very similar to that.
Sure.
We're going to recommend we rebalance portfolio annually to make sure you don't get outside of your asset allocation and your risk tolerance. Well, the market's doing the same thing.
You bet.
And it's something on educating people that when we see this, we have to just figure out how we get through it.
You bet.
It's not changing your risk tolerance, it's not changing your time horizon, and it's not changing your goals. So if those three things didn't change, then we probably shouldn't be making major changes to any of your investments, any of our, you know, projections, any of that stuff.
And quite simply put, think about it from a numerical term. If you're pulling 5% off, bear market greater than 20% down, let's say the market returns in year one out of the gate, like it did for some of our clients in 2008 that retired in 2007. It happened to people. With that, you're pulling 5% off, you're down 25%. Now you've taken 30% off in one single year. 30%. If you think someone's emotional when the market's down that much and they still have a paycheck, think about not having money come in from a paycheck and having to pull off this account that you're watching go down by 30% in 12 months.
Yeah. That'll bring out some emotions.
It will. And here's the other thing that people are quick to not even think about is when if your portfolio is down 30%, oh, and by the way, year two, you're still going to pull off money because you still have to live. You don't just have to do 30% to get back to even, because we have a lot less money for money to make money on, right? So now all of a sudden, instead of doing 30%, you've got to do high 30s, low 40s just to get back to even.
I think
That's a big
number. One of the numbers I looked at was at the end of July, the market was down 22. We had to get to 28 back up to recover.
Sure. Yeah. Right there. That's it. And again, in year two, you know you're taking. You should take 5% off the new number.
Yeah.
You should.
Yeah.
Nobody does that.
Nobody. So when we're talking about risk, time horizon, and goals, you've got to keep that emotion in check during those times so you don't make a decision that costs you gains when the market starts going back up.
Correct.
What the piece we talked about before we started recording, you know, missing the 10 best days. The 10 best days of the last 20 years usually happen within 2 weeks of the worst day in the last 20 years. So keeping people from taking their money out on the worst day, so they get that best day to get those gains back. I mean, what's that chart say the difference?
So yeah, it's good. I've got it pulled up here. It literally fully invested over that 20-year window from 2002 through 2021, 9.52% average. Okay, that's the S&P 500. If you miss the 10 best days in a 20-year window, 10 days, that 9.52% average is almost cut in half, down to 5.33%.
Wow. Yeah.
Now, when you apply compounding to that,
right,
the rule of 72 tells us that less than 8 years fully invested, your money's doubling. So basically it doubled twice plus, right? Ridiculous impact. A lot of people that when the market goes down, they're like, what are we going to do? What are we going to do? And my first instinct is to tell them, find more money to invest. It's on sale. What do you do what would you do? What would you go buy if the entire Walmart store were 20 to 25% off bear market territory?
Yeah.
What do? You go stock up. Nothing's ever on sale that much at Walmart. They have an everyday low price, but nothing's ever on sale that much, right? Clearance aisle, okay. But at the same time, our mind goes to, well, I need to get out of this before it goes lower.
Yeah.
And what you just said about those best days happening within a small time frame of the worst days and needing to be invested in those so you can achieve that 9.5% that was over that 20-year window and not be at that 5.5%.
Yeah. And the number gets even worse, right? If
Number
you
gets
miss
worse.
20 days. I mean, let's just do some quick math. 20 years, so 10 days out of 3,600 cuts your return in half almost.
Right. Let's move it down to missing 20 days. Your average annual rate of return goes from 9.5% all the way down to almost 2.5%. That's 20 days. You want to go out to missing the best 60 days, you're now down. You've lost money. Okay? You're down 4.8, almost 5%.
Wow. So that I think is a great segue into the emotions getting involved in investing and people trying to time the market, right? Oh, I got to get out at the bottom so that I can prevent this continued loss, but then I'll get back in on the way up. And this chart says that don't do that. Don't put in all that work.
Sure.
Just stay in the entire time, keep contributing, don't change your allocation, your targets, your risk, any of that. You're looking at 9.5%.
Right, and that's at 100%. That's S&P, right? So to piggyback off that, a lot of people are like, well, should we go to cash? Should we do this? Should we do this? And what should we change? Well, we've already done that on the front end. There's nothing to change because you're invested based on your risk tolerance. Your risk tolerance, the questionnaire that's taken, tells us how much you can tolerate or how much you should be able to tolerate. The problem that those risk questionnaires don't take into account is the window from 2010 to 2021, 2020, 2021, I guess. You just go all the way through 21. It doesn't take into account that those people who may be a little bit more risk averse, it doesn't take into account those people who may be a little less risk averse, now seeing a negative when they never have before,
right,
or haven't in a long time. They're all of a sudden, what do we need to change? Well, we don't need to change anything. We've got your allocation to fit.
They think this time's different.
This time's different, right? They think this time. And
we joke about that because we hear it all the time.
We hear it all the time.
And you go back through time, you start looking at the history of all these bear markets and recessions and all of this stuff, and it's the cycle of the market. I mean, there's classes taught on, the anatomy of a recession. Where are you at in the recession? Are you at the peak? You at the valley? You're on the way. There's all of these, the trough. You're all these terms because they know that's what it does. It's done it enough times over the last 100 years people have educated themselves on it, and there are technicals involved. There's a whole bunch of stuff that goes into that, but staying the course and taking emotion out of it shows historically that you get a higher return. Right? We used to have a conversation a lot of times about dollar cost averaging versus lump sum investing.
You bet.
Right? And it's that whole thought, oh wait, it's on sale. Hey, how about I buy a little more than I normally would now, because I understand it's a good investment, it's part of my assets, or it's part of my asset allocation, fits my risk, it fits your profile, so then that way when it starts going back up, or if it does go down more, hey, I understand what this does.
You bet. Yeah, it's an interesting, it's one of the more interesting parts of this career, I think, because you've got all the numbers and all the things that happen, every day, and it's good to find someone, and a lot of people that will call when there's market volatility, like, they just want to hear it. They just want to hear you say it. They just want to hear you say, hey, maybe you look at adding money here, here, and here, and here's why, versus, hey, let's just sell out all this and go to cash.
Yeah.
You want to know the problem with selling out of the market?
What's the problem?
The problem is deciding on when to get back in.
Correct.
Because if you get out of the market, you did so because of what? We talked emotion.
Yeah, emotion.
You get out because of emotion. Okay? You may think, oh, something's going to happen, oh, something's coming, oh, this is too good, and maybe you get lucky and you're right. But the true problem that lies between getting out of the market is when to get back in. Play a scenario out where the market's already down 20%. Okay? You get completely out of the market. Market goes down another 10%, so now we're down 30. Okay? Do you get back in at 30% down?
Probably not.
Why not?
Because you think it's going down more.
Because you think it's going to go down more. Right? What if it goes down 40? So ultimately, what almost every time ends up happening is that those people who wait and save themselves 10%, technically, save themselves 10%, could have, if they had just bought back in at down 30, inevitably will always end up on the other end of that because they want to see stability.
Yeah.
And they're not going to see stability until the market's higher than when they sold.
Just like when we're talking about the best days are within 14 days of the worst days.
You bet. They're missing that.
They're missing that.
For sure. They are missing that.
Yeah, and I think it's just putting yourself into a position where you've educated yourself enough that you say, this is what the market does. Yes, it could go down 30 or 40%. And, everybody's situation is different. When we're talking about somebody who's in retirement, getting ready to retire, still accumulating assets, just getting started, all of those people are different scenarios. Much harder for somebody who's already retired to say, hey, you got to ride this out.
It is.
As you talked about. Now you're taking 7% versus 5%. Mm-hmm. So all of those are different conversations, but like you said earlier, it's the same conversation over and over again. Raising interest rates, war in Ukraine, there's all of these impacted factors, mm-hmm. but it doesn't change your goals, your time horizon, your risk tolerance. Mm-hmm. So that doesn't change your investment profile. So we need to wait this out.
Correct.
So I think having those conversations a lot of times with clients makes them feel better. Okay, I think I understand why it's doing this, what's going on, why I'm going to stay in the investments I'm in. All right, so as we talk about, every 2 years there being a 10% decline or whatever that number is, typically in a year, there's going to be some downside, there's going to be upside within that calendar year. Right? For some reason, a lot of times we go back and we look and we say, oh, well, what's it done since January? I don't know why we arbitrarily pick January to manage that from. But so historically we take all this data and we start looking at it. And looking at this chart here, there's very few years that are either completely down or completely up. It's got both on both sides of these charts. So we're going to see some negatives. We're going to see some drawdowns and some pullbacks. And we're also going to see some run-ups within those calendar years. Mm-hmm. So I think getting comfortable with that and understanding the market is volatile. The market does what the market does. I tell people that all the time. They're like, explain that to me. And that's what we talked about earlier. You get these run-ups, okay, and then the market says, hey, you can't continue to run on these PE ratios and all this stuff. They get too high.
Valuations are just get to where they're not realistic.
They're not realistic. We saw that during COVID.
You bet.
There's what we call the COVID stocks that ran up so high, and everybody's like, how in the world can this company be worth that? Well, there was a very short amount of time where the product was in crazy demand. They couldn't keep up. They were just this niche product that fell right in there. Well, long term, not going to be able to manage that.
Which they haven't.
Yep.
Retreated back.
So the market does the same thing. As a whole, right? Individually, you're going to have some players that make it and some that don't. But as a whole, the market itself is going to find those and correct those because it just can't support the weight of it. So I think it's important for people to know volatility is what makes the market.
It is. And it's kind of a weird, and I get it that, you're not ever going to talk to an investment guy that's going to tell you not to invest money. I get that. At the same time, especially with younger people, in my opinion, should welcome that volatility, right? Investing during those times is ultimately what's going to really create some wealth for those people. And if those people from an earlier age are able to adopt that train of thought and trust, you've got to trust the process, right? We've got a process here that has a really long track record with a lot of variables, but ultimately it all comes back and tells us the same thing, right? For each of these sectors of time that we even peg on it. You talked about January through December. It's an arbitrary thing. That's how we define time in years. That's why we look at it like that. A lot of the times what we're doing when we meet with clients and do reviews, we look at rolling 12 months. We don't look at just what was the last year. It doesn't do anybody any good for me to sit here and tell you what you did last year when since January 3rd, your money's just kind of basically gone down, right? So understanding where we're at from a rolling standpoint helps to kind of understand, we can have these ups and downs within that 12 months, knowing that 12 months is just what we use as a time and date stamp, It's an arbitrary number. That's what it is.
Well, I think it's just a length of time people are comfortable with.
It is. Easy to relate.
Oh, we met one year ago.
Very relatable.
What has this account done since the last time we were together?
You bet.
So is there anything in closing, Jason, about emotional investing you'd like to make sure that people know?
I think if nothing else, I want to make sure that people know, and I'll have people that'll call and they'll say, I'm sorry for taking up your time, but I had a question about this, the market's going. Don't apologize for that. That's what we're here for. I just literally said that we do that with 50% of our time. It's what we do.
Yeah.
People don't realize that. I think that a lot of people don't think that that's really as much of a part of it as what it is. But at the same time, what it does is it allows our clients to have us as an outlet, us as a sounding board. Talk all those conversations you have at work about the market. I know they happen, right? All the political conversations that you have at work or at home that you're like, well, I think this will affect the market, or somebody told me this was going to affect the market. What do you think? We try to be the best at what we do. We strive every day to do that. We are living this, and albeit, nobody's ever right about everything. Nobody's right 100% of the time about when to get in the market, what to invest in. But as a whole, what I know we can do, and we do very well, is help educate clients and help clients to really understand how they can utilize volatility to really as an advantage for them versus something they fear. How do we safeguard income in retirement? What's that number? What's that buffer? Hey, Brett Rice, what's your buffer in retirement that you need to get to so you're not worried about retiring at the wrong time? Sitting there and actually being able to tell people, do this. This should put you at this point, which at that, you're going to live through the downs, but you can live through the downs.
Right.
And I think that's something that a lot of people don't really know that we do as much as we do, and that we take it to heart. We understand. We're not going to yell at you for thinking you're wrong or calling. We're not going to yell at you saying you're an idiot for wanting to take your money out. It's more we use that as an educational opportunity, because at the end of the day, we want you to make more money. We want you to have more money. We want you to create your wealth and be able to do with what you want. Create a legacy if you want. Just basically fund your retirement if you want. Everybody's different.
Right.
Trying to match up those goals, utilizing planning, and managing those emotions.
Yeah, it's great. Again, thanks everybody for joining us today, watching the video. Jason Pike, Brett Rice, Core Vision Financial Group. So again, go to our YouTube page and subscribe so you're notified when we post a new video. And again, thank you for taking the time to watch the video. Appreciate it. Thank you.